Have you ever wondered if there's some kind of hidden pattern that connects, say, a spiral galaxy, the petals on a flower, and the financial markets? I know, it sounds a little out there, but today we're going to dive into a concept that claims to be exactly that. It's all about Fibonacci.
Okay, so to really get this, we're not going to start with some crazy complicated trading chart. No. Let's actually start with the world all around us.
I mean, think about that for a second. This quote hits on a really wild idea, that a specific mathematical pattern, often called the golden ratio, is like a fundamental building block of the universe. You see it everywhere once you start looking. The curve of a seashell, how trees branch out, even the proportions of our own bodies. It's just there.
So where does this natural blueprint come from? Well, it comes from a super simple sequence of numbers. You literally just add the last two numbers to get the next one. That's it. It was made famous a long time ago by a mathematician named Leonardo Fibonacci. And this little sequence is basically the engine that creates that golden ratio we see all over nature.
And this right here is the central question we're tackling today. If the markets are really just a big reflection of human psychology, our collective hopes and fears all playing out, then isn't it possible that this same natural rhythm could also shape how we buy and sell?
So let's make that jump. Let's see how traders try to take this universal code and apply it to the often chaotic world of market charts. And they do this with a specific tool called Fibonacci Retracement. You see, here's the thing about markets. They almost never move in a perfect straight line. Even when a stock is shooting up, it'll pull back, take a breath, and then maybe keep going. This tool is all about helping traders map out those potential resting spots, the places where the price might pause or even turn around. Think of them like possible floors or ceilings for the price. Now, the good news is you don't need to be a math genius to use this. Traders really just focus on a handful of key zones that come from those Fibonacci numbers. These are the levels where they're watching, waiting to see if the price slows down, finds its footing, and maybe, just maybe, heads back in the direction of the main trend.
All right, so theory is one thing, but how does this actually look on a chart? Let's get practical and talk about how traders draw these lines and start reading this unique map of the market.
It honestly boils down to three pretty simple steps. First, you've got to find a clear, obvious price move. This doesn't work well in that messy sideways chop. Second, you just connect the dots. You draw one line from the very start of the move to the very end. The software does the rest, popping those key levels onto your chart. And third, you just watch. You observe. It's an observation tool, not a crystal ball.
And here's the one rule you absolutely have to remember. Which way you draw the line matters. If the price is moving up, you draw from the bottom of the move to the top. This creates those potential floors or support levels. If the price is moving down, you do the opposite. Draw from the top to the bottom. This creates potential ceilings or resistance. It really is that straightforward.
Okay, this all seems pretty cool, right? But it begs the biggest question of all. Why in the world does this even seem to work? Is there some magical force driving the markets? Well, the secret ingredient might not be what you think it is. So, what is it? Is the magic really baked into the math? Some hidden code that controls everything from a snail shell to a stock chart? Or could the answer actually be something a lot more human?
And here it is, the big reveal. The power of Fibonacci might not come from some universal, mystical law at all. It might just come from a shared belief. Because millions of traders all over the world learn about these exact same levels, they all watch them. They all place their buy and sell orders around them. And in doing so, they cause the very reaction they were expecting to see. Think of it like this. If millions of people are using the exact same roadmap, and that map has a big circle around a certain spot saying, potential stop here, what's going to happen? Well, drivers, or in our case, traders, are going to slow down and react when they get to that spot. Their collective action is what turns an imaginary line on a map into a very real traffic jam on a chart. And this brings us to probably the most important point of all. Fibonacci is not magic. It is a tool. And just like any tool, it has its limits. It is absolutely, positively not an oracle that can predict the future. Yeah, it's so important to know these limitations. For one thing, it's subjective. Where I decide to start and end my line might be totally different from where you do. It also really struggles in messy, directionless markets. And this is the big one. Prices can and absolutely will blow right through these levels sometimes. That's why you should never ever use it by itself. It's a confirmation tool, something you use with other signals to build a bigger picture.
So we're left with this final idea to chew on. Is the market truly dancing to the rhythm of some hidden natural code that connects everything in the universe? Or is this whole thing just a fascinating case study in mass psychology, where our shared belief in a system is actually what gives it power? You know, maybe the real answer is somewhere in the middle.